In this example, we're going to talk about transfer pricing. So if you remember from the Chapter 11 lecture and chapter readings, how minimum transfer price is determined depends on the amount of capacity, the variable and fixed costs, the market price, and the different options that we have within the organization. So we have information here about a company's audio division that produces a speaker. They sell the speaker to the outside market for $60. They also have an internal division, the Hi-Fi division, that can use 5,000 speakers a year. The Hi-Fi division received a quote of $57 from an external supplier. So they can either purchase from the external supplier or we can do an internal transfer. Whether we do that or not depends on a lot of factors. The first factor is always capacity. So is the audio division losing outside market sales if they transfer internally to the Hi-Fi division? So in this first scenario, we're only selling 20,000 speakers per year to outside customers, but we have a capacity for 25,000. Therefore, we have full capacity to meet that order of 5,000 speakers per year. As we know from the textbook and the lecture, if we have capacity, then our lowest acceptable transfer price should be whatever covers our variable cost per unit. The lowest acceptable transfer price is our total variable cost per unit. For the Hi-Fi division, we want to know what the highest acceptable transfer price they will pay the audio division. Well, that is determined by the price that their supplier offers the speaker to them. So since they can buy that speaker from an outside supplier for $57, they are not going to pay more than $57 internally. So now our range of acceptable transfer prices is anything between $42 to $57. And managers would need to decide between that amount what price works best for both of them. Number D says, from the standpoint of the entire company, should the transfer take place and why or why not? Well, from the standpoint of the entire company, audio division doesn't have market demand for those 5,000 speakers and they have extra capacity. So anything extra that they are able to make and transfer out just adds to their bottom line. So it benefits them and the company as a whole to transfer to the Hi-Fi division at any price over $40. The Hi-Fi division is able to lower their costs if they transfer internally, which then therefore increases their profit margin. So the Hi-Fi division is going to save costs if they take that as an internal transfer instead of buying from an outside supplier at $57. So yes, from the standpoint of the entire company, the transfer should take place. The second analysis says, what if we sell 22,500 speakers per year to outside customers? Now we only have capacity for half of that 5,000 order. In order to fully fulfill that transfer to the Hi-Fi division, we are going to lose out on $2,500 worth of sales to the general market. So when we don't have full capacity or we only have partial capacity, then the lowest transfer price is variable cost plus the lost contribution margin from lost sales. So the lost contribution margin from lost sales is the contribution margin, which is sales price minus variable costs, times the number of units that sales were missing, divided by the full cost of the order, or full units in the order. So our contribution margin, $60 minus $42, is $18. So we have a contribution margin of $18. So our Loss contribution margin is 18 times the lost sales, 2,500, divided by 5,000. Oh, they don't like commas. Or 9. So the lowest transfer cost we want is the $9 plus variable cost. So the lowest transfer price we will take is $51. Just like the first example, the highest acceptable transfer rate for the Hi-Fi division is that $57 they've been quoted from an outside supplier. Now our range for transfer prices is $51 to $57. From the standpoint of the entire company, should the transfer take place, this is still a good idea for the entire company as a whole. Okay, so the audio division is still fulfilling their capacity. The only thing they would have to really consider is whether or not we're angering our customers by not selling those 2,500 speakers from the lost sales. But with the transfer price covering that contribution margin from lost sales, we're still getting the same amount of money as we would as if we sold. And the Hi-Fi division is still saving on costs. In our third scenario, we sell 25,000 speakers per year to outside customers. So our demand is at full capacity. We do not have any extra capacity to take on orders for other divisions. When we have full market capacity, the lowest acceptable transfer price for us is market price. So the lowest price we would take is $60. The Hi-Fi division is still only going to pay $57. So now we do not have an acceptable range which to make transfer prices. And in this case, when one division is at full capacity, we should not let the transfer take place, as it would be bad for the company. We would either be, if we kept it at market price, then that would make the audio division happy, but the Hi-Fi division would be losing out on that profit margin of $3 per unit. Our last example in Chapter 11 is the allocation of service department charges. So the allocation of service department charges is very similar to the allocation of overhead that we've done in previous chapters. So when we're allocating service department charges, these are departments that provide services to the business as a whole. Departments like human resources, accounting, information technology services, maintenance, janitorial services, etc. So we allocate those onto the units that are producing and selling goods to really understand the cost of operating a business as a whole. So in this example, we have two manufacturing departments that we're going to allocate maintenance department costs to. We see that variable costs are allocated at 40 cents per machine hour, and our fixed costs are allocated by these peak period requirements of capacity. So we want to allocate costs to the forming department and the assembly department. And we're going to allocate variable cost and fixed cost. So our variable costs are 40 cents per machine hour. In the forming department, we have 190,000 machine hours times 40 cents. And in the assembly department, we have 70,000 machine hours times 0.4, 70 cents or 40 cents. In our fixed, we're going to allocate this 150,000 in fixed cost times the percentage of peak capacity. 70% for forming and 30% for assembly. So our total allocations, 181,000 for forming and 273,000 for assembly. Question 2 says, how much, if any, of the actual maintenance department costs for the year are a spending variance and not allocated to any department? So now we need to know what is the difference between what was allocated and what our actual costs are so that we can determine our spending variance for the department. So what was allocated for variable costs are forming and assembly added together. And then we have our actual cost. So our actual variable costs were $110,000 and our actual fixed costs were $153,000. So we add those together. And then we look at the difference between the two. So the difference between the actual costs and our allocated costs give us our spending variance. So for a total spending variance of $9,000 for the maintenance